Welcome, welcome. So today we're talking about make me move. Is now the time to buy or sell? And I have with me one of my favorite lenders, Anaí Rivera, and she is going to talk to us a lot about the lending side because I'm here to talk about the home buying, home selling process, and she's going to talk to us about the lending side so we can each stay in our lane. So
Love that.
I'm Brittany. I am your resident real estate agent, coach, and investor. I've been investing since about 2018, and in 2020 I got my real estate license and jumped in full time. And then I've been a coach since about 2021. So I teach agents how to do this. Before that, I was doing about 20 years in educational leadership, where I was doing coaching, training, mentoring, consulting, all of this same kind of thing. And now I've just kind of transitioned over to real estate. And so I love doing this. And I especially love doing this kind of seminar type style webinar, I guess, because it makes it just a really fun, easy way to get the information out that everybody's asking about. And this topic in particular is one that everybody's been asking about. So I'm excited to jump in and share it with you. So Anaí, tell us a little bit about yourself.
Yes, thank you, Brittany. So that was an awesome introduction. So yeah, my name is Anaí. I am a mortgage lender. I'm actually a broker. So we work with different companies, not just one. And a little bit about my background. I actually went to UC Davis. I graduated in 2019, and I've been doing loans since that time, as a matter of fact. So during that time, I actually got my license. I got both my DRE and my NMLS license. And then fast forward, I actually started working for a company right out of college, doing loans as well. So I've been doing loans for over 8 years now, and it's been working perfectly fine. I love what I do. I love to help and educate as many buyers as I possibly can. And this is truly my passion to help others. So I'm definitely excited for all the potential families that we would help this year.
Awesome. All right. Well, let's talk about where we are going today. So the topic on everybody's mind is interest rates. We've been talking about this for, I feel like, the last like 4 years. We've been talking about interest rates. So we're going to jump in and talk about that again. We're also going to talk about loan programs. Right now, everybody's talking about this dream for all. And so I definitely wanted to bring Anaí in to talk about that with us too. And then we're going to talk about predictions, my predictions, her predictions, what the experts are predicting. We just want to know what's going to be happening in 2024. Then we want to get to the bottom line. And then finally, we're going to say, all right, now it's your move. And we're going to talk about next steps. All right, so jumping in, interest rates for the last year, this is like the last quarter since September of 2023, they've been hovering in the sevens, and now they've started coming down to like the mid sixes. So they were getting up like in late 2023. Well, I guess in October, this says October, November 2023, it was in the high sevens. So where are we at today with interest rates?
Yeah, so that's a great question. So in terms of FHA, so there are different kinds of loan programs that we usually go for first-time home buyers. But right now, the lowest rate I've seen is actually a 5.875, which is on an FHA loan. So that is amazing news, just because we are starting to see, interest rates drop again. So as of October of 2023, rates were at their highest they've ever been. They were actually at their 8%. So now we're slowly starting to see, interest rates dropping. Like I said, as a broker, I do have access to different companies. So not everybody's going to be able to offer this 5.875, but most people, always go based on the average. So depending on our credit score, then we can definitely try to get that rate. So we are going to continue seeing a decline in interest rates. And I'm so excited for that because that's going to allow more families to come into the market and be able to purchase a home.
Absolutely. I love to hear that. So what did you say? 5.5%? No.
Yeah, 5.75. So 5.75 to
5.75. That's really low. Okay, but realistically, who would be the person, like who's the avatar who qualifies for that?
So it would be somebody that has great credit, so somebody over the 700 credit score, somebody that, is currently employed that is going to be able to show income for the last 2 years. So pretty much it goes based on credit score. We want to make sure that our credit is strong, because that will determine what rate we get. So that would be like the ideal candidate.
Okay, and what kind of down payment do they have to put down?
They actually just have to come in with as little as 3.5%.
And I love that you're saying that, because so many people have the misconception that they have to come in with 20%, right? And
Yeah.
20% for so many people, especially in our market where, our average price point is around 800, 900,000. So
Mhm.
20% of that is this astronomical number that most people don't have that sitting around in their bank account. But 3.5%, now we're starting to talk about a more realistic number. So is that 3.5%, is that accessible to everybody? Can everybody put down 3.5%, or is that just for special buyers?
Yeah, so it would be anybody that currently does not have an FHA loan. So we can only utilize this FHA loan once, meaning you cannot have had it in the past or currently have it on your property. You can only use it once, like I said. So 3.5% would be for anybody that's going into the market that's brand new. In case you don't fit those specific requirements, and we can always look into doing a conventional loan where you actually just need 5%. So no matter whether you're a first-time buyer or not, you can actually take advantage of coming in with as little as 5% down, even if you are purchasing another home.
Okay, so still 20% is not the number that everybody has to shoot for. Now, of course, the reason that a lot of people say that 20% is because once you hit that 20% loan to value or 80% loan to value, that's when the PMI or the mortgage insurance falls off, or you're eligible to get it removed. So that's where that 20%, that magical 20% number comes in. That's what everybody's talking about. All
Mhm.
right, let's keep it going. Okay, so this is an image that I always love to talk about. So what we have here, what this graph shows, is this graph shows the interest rate over time. And it shows, of course, in like the 80s and 90s, the interest rates were like way up here. And people always talk about, I remember when the interest rates were 18%. You're like, okay, grandma. But the reality is that interest rates were a lot higher. And
Mhm.
interest rates have come down, and they went down to like 2%, which we realistically are not going to see again.
Mm-mm.
We saw that because of a worldwide pandemic. We are
Mhm.
not going to see that again. And if we do, it's going to be because of some kind of like catastrophe like that.
Yeah.
And so we don't want to see that again. It was great for the people who were able to take advantage of it, but it's not likely going to happen anytime soon. So when we look at these prices, though, what we fail to remember is that as these interest rates drop and go down, appreciation and home values just go up and up and up and up and up. For the most part, they have a steady incline. Now, here we see a dip. This dip was in 2008. So everybody talks about, oh, the fall of 2008. But look at how much higher we've come since then. And I mean, if you took this goes to 2020, if we took up into 2023, we'd be like way up here. And so what I love about this picture is this picture shows the rate volatility is this guy with the yo-yo. The yo-yo is the rate volatility. It's going up and down. And then the housing appreciation is that guy walking up the stairs. And so the yo-yo, he is using that yo-yo to go up and down. So that is volatile, going up and down, but he is consistently walking up the stairs. And so what happens is that he's walking up the stairs. And so even if at some point something happens to where the housing prices slow down, maybe he's not running up the stairs anymore, maybe he's just slowly walking up the stairs, but almost never is he going to turn around and fall down the stairs and go completely backwards. He's
Mhm.
always going to keep going up those stairs. And so even with this yo-yo and the rate volatility, at some point when he buys his house, that yo-yo is going to stop. It's going to freeze where it is, and he's going to keep walking up the stairs. His housing appreciation is, or her, is going to keep going up. And so we want to keep that in mind, because I think that this is a really great visual to just remember that your house is your largest asset a lot of the time. And so if you are um, just always focused on interest rates, you're missing the bigger picture. The bigger picture is that you have this asset that is increasing over time. So we talk about, it's not about timing the market, it's about time in the market.
Yeah.
So we want to make sure that we're not timing the market. So stop trying to time the market. Not only is it a waste of time, but even for the experts, the probability of failure is high. And if you followed the experts over the last 3-4 years, you know that they talk about, I mean, they've been wrong 150 times over the last 4 years. And so you really don't need to fit, you don't have to listen to what the experts are saying. You have to look at, like, what is my situation? What do I need today? I just did a video and it was talking about like the top 5 reasons to move, and not a single one of them was about interest rates. Not a single one of them had anything to do with that, because it's not about the interest rates. Yes, you're making a financial decision, but the bigger picture is your house appreciation is going to go up. So,
Yeah, and actually to add to that, we actually
please.
are seeing that every year, for the past 3-4 years, homes have appreciated significantly by at least 5%. So we're going to continue seeing that as we progress through the years. So it's not like you're going to be upside down on your home. That was way back. It never really happened based on the graph. A lot of people are saying 2008, my house went from X to Y, but not anymore. Honestly, a lot of people are seeing the value that it brings, not only like generational wealth, but also for you. It's kind of like a piggy bank. You're adding money into your home. Eventually, if you want to sell your home, you already have that equity that you could carry either to another home, or maybe do a cash out and just go to another state. I've seen a lot of people do that. So it's definitely an investment that you want to be able to obtain as soon as possible before it keeps on increasing.
Yeah, absolutely. Because not only our housing appreciation, your housing appreciation is increasing, but the cost of rent is increasing, the cost of living is increasing, everything's going up. And so at some point, it's going to make it so that it's totally unaffordable to live where you want to live. And so you have to get in and you have to buy at some point to maintain that standard of living, to maintain those costs. But, I love that you brought up 2008, because we talk about this, and I feel like at this point it was so long ago that a lot of people forget. And so just a reminder, the whole reason that 2008 happened was because of bad lending practices that are are not practiced anymore. So it was because they would give an 80% mortgage, and then they would give another mortgage of 20% for the entire down payment, so that 100% of the house was financed. And then we, on top of that, had a foreclosure crisis, because we had all of these homes that had balloon payments on them. And so those balloon payments were all of a sudden getting called due. And when they couldn't be paid off, the banks were failing. And then the banks were trying to foreclose, and all of these houses were now pushing all of the markets down in value. We're not seeing a housing crisis anywhere near that at all now. Nothing like that is happening. In
Yeah.
fact, it's like something, there's some statistic and I can't remember what it is, but it's some high number, like 85% of people owe less than 50% on their mortgage. It's some like ridiculous number. I can't remember what it is.
Yeah.
But it would be better if I knew that.
And you know what? That's actually true that you mentioned that because it like back then, like you were saying, it was bad lending practices. So people would literally come to loan officers and say, hey, you know what, I made $200,000, but it was stated income. So there was no form of really diving into people's financials and making sure that they can afford those payments. So that's part of the reason why a lot of people, lost their homes, unfortunately. So,
Mhm.
fast forward to now, 2023, we go through the entire process. We check income, we check debt, we check savings, we check credit. We want to make sure that these buyers that are now acquiring their homes can actually afford it to make sure they are not losing their homes. So
Yeah.
it's definitely been, a change in the lending industry as well for the better, yeah, a lot of people say like, no, there's so many requirements, but it's definitely benefiting all those who want to, buy because we do an in-depth review to make sure you're able to qualify.
Yeah. Well, when you're talking about buying this huge asset, it makes sense to be able to do that. And I think, that's one of the things too is that that once you have a home, you generally know that you can afford to stay there unless something dramatic happens. You lose your job or something like that. And so, and even if that happens, one of the reasons why a lot of people are talking about, oh, foreclosures are coming. And the reality is, foreclosures are not coming, at
Mhm.
least not in the way we saw before,
Yeah.
because all of those people who might be facing foreclosure have a ton of equity in their homes. And so they can sell their home a traditional way and do exactly what you said. They can cash out and move to a less expensive area. They can go out of state. They can do something different. They have options where before they didn't have any options. It was just foreclose or get out.
Mhm.
So it's definitely a whole different scenario at this point. Okay, so this graph just kind of shows us what the averages have been. Just another visual to kind of show us what this was. So again, this is like back in the 80s where interest rates were 16. This is 16% on average for the year. It actually topped out at like 18%. So on average, across the board, this ends at 2022. But across the board, the average was 7.81. Now, what's the average for today for like an FHA loan?
Yeah, anywhere between a 5.875 to 6.5. That's the
Yeah.
range you've been seeing.
So we're still lower than what we're seeing here at 7.81 is the average across 40 years. So it is good to see that we're still lower than the average. Now, what we do know is that buyers come out in droves when we hit about that 5.5% mark. So
Mm.
at that 5.5% mark, that's when we start seeing lots and lots of buyers come to the market. And what happens when lots of buyers come? It's
It-
supply and demand, right?
Mhm.
It drives the prices way up. We're already seeing that. We're already seeing, like, right before we started this on IE, you were telling me that you're super busy because a lot of buyers are starting to come out of the woodworks now and starting to say, okay, this is the year that we want to buy, right?
Yes, exactly. And I feel like that's been, like a common thing. A lot of people were waiting for those rates to drop. But in the contrary, you should actually buy when interest rates are a little higher because it actually reduces the amount of competition out in the market. So you definitely want to make sure that, even though if you are able to afford it with the higher interest rate, just bite the bullet for a few months and refinance like a lot of people have been doing. So I kid you not, a few months ago, 6 months, 7 months ago, we came across a few clients at open houses and we would notice that, they were getting high payments because of the rates. But fast forward to 6 months later now, we are seeing people now take advantage. They got the home, they got a good price on the home. They even got some seller concessions to buy down the rate or even to cover their closing costs. And now they're able to take advantage of the rates dropping. So they secure the home and ultimately now they are going to refinance. So that is a potential thing, that a lot of people probably didn't think they could do, that they could refinance sooner rather than later. You don't have to wait for forever to refinance. You can actually do it in as little as 7 payments after your loan is already originated. So it is something that now rates are dropping, now more people are coming into the market. So it is going to create a little bit more competition because we have been seeing, there's not a lot of homes on the market, unfortunately. So we definitely want to make sure that anybody that is truly interested that reaches out to us to, just set a plan of action for them and make sure that they're able to afford a home soon.
Yeah, absolutely. And I think that I love what you're saying about that, because that lines up exactly to what really what we'll talk about later is when we see lots of buyers coming to the market, it's going to drive those prices up. And right now, we're starting to see more buyers coming to the market, which is starting to drive those prices up. And so, what we're telling people is if they're ready to buy, now's the time to buy, because it's better to buy now and then be able to refinance than have to pay $200,000 over asking in 6 months
Mhm.
and be potentially priced out of the area that you want to be.
Exactly.
So we're totally on the same page there. All
Mhm.
right, so now let's talk about loan programs. All right, so the biggest loan program that is all the rage right now is the Cal FHA or HFA. I always say FHA, it always throws me off. Okay, so tell us about the Cal HFA.
Yeah, so it's going to be a program that's specifically for first-time home buyers, and they have to be first generation. So what does this mean? This means that their family members or mom, dad cannot have owned a property in the last 7 years. So this means that you are going to go into the market as a first-time home buyer, and a first-time home buyer, what that means is that you cannot have had any ownership in any property in the last 3 years. So, that also means that if you are, for example, a spouse, your spouse has a home and you're living in it, unfortunately don't qualify as a first-time home buyer. So there is a specific definition for this, but it's definitely aimed at anybody who's going to be the first generation to buy a home. That's who this program is targeting. It is going to be giving buyers 20% for either their down payment and or their closing costs. So it could be combined. So for example, if the buyer wants to do 15% for their down payment and 5 for their closing costs, they are able to do it. So this is definitely a great program for all those people who may not have the savings, who are just kind of on the sidelines, kind of waiting for interest rates to drop, because it is also going to make a difference in your payment. Having a substantial amount of down payment, in this case 15 or 20% down, is definitely going to bring down your payment as well. So it's a great program, like I said, for anybody that needs that extra push, maybe with the down payment, to be able to have maybe a more affordable payment. And it also is also going to increase your purchase power, because now you're able to come in with a bigger down payment.
Awesome. And I heard that there's a lottery for this now, right? It's not like first come, first serve.
Correct. Yeah. So that's another key point, is that we are actually going to be anybody that does reach out for this program is going to be entered in a lottery. So basically, we as loan officers are going to have to take the application fully. We're going to have to submit an application to Cal HFA to make sure that we are one of the people that are in line to obtain this program. So once again, it's going to be a lottery. So if your name gets added and chosen, we don't know exactly how much time people are going to have to shop around. Those guidelines have not been issued yet. They will in March or April this year. So we're going to know then what exactly it's going to entail. But for the meantime, we do know that you are going to get a voucher and you're going to get in line pretty much to see if you are able to receive the funds. If you are perfect, you'll be issued that voucher. You'll be able to shop around, and you are going to have a time frame for you to be able to shop for the home. So if your time expires, then that means your voucher is no longer good. So now you're going to have to get in line again and see if you're able to obtain that. So that is a little bit of a great, incentive from the state of California to give to buyers. But like how we were saying, it is going to drive up the demand as well, because now more people are also going to start coming into the market. So it's definitely great for anybody that's a first-time buyer, but it is going to, like I said, drive potentially the prices up as well.
Yeah, that's good to know, though. I didn't know that there was, I mean, it makes sense, but I didn't know that there was a timeline for them needing to buy. So
Yes.
Good to know. And that is a great product and it's a really good way for people to get in. But I mean, there's a lot of specifics there that you mentioned. And I think there are even more that you probably didn't mention. So the best way for people to even find out more is to really just reach out and get in touch with you, right?
Yes, yes, exactly. And it goes case on by case, right? We want to make sure that fully everybody is approved, that we have some kind of credit information. We want to make sure the credit meets certain guidelines. We want to make sure that you're ready to go when the program does go live. Like I said, they haven't released an exact date, but we do know that it's going to be April or March of this year. So we really want to make sure we're ready to go for when the time comes, just to be able to submit that application and really just kind of wait for us to get that voucher to start shopping for homes.
Okay, perfect. All right, so that's a good one, and that's like the top of everybody's mind, but there are still a lot of really good loan products and programs out there. So I want to kind of like compare and contrast these. So the next one that I want us to talk about is the FHA. Tell us a little bit about the FHA loan program and like how it's different.
Yeah, so with FHA, this program, we do offer two different kinds of programs with FHA, like in terms of down payment assistance. If you need down payment assistance, we do have a program where we actually give the 3.5% for your down payment. The only thing you would be responsible for would be covering closing costs. It is through an FHA loan. Now, we also have the other option where you can bring your own money, which would be the 3.5% in order to be for your down payment and of course your closing costs. So those two options. And what really FHA is a program that gives you that little peace of mind of only having to bring down the minimum down payment to be able to get into a home. It does have two different kinds of mortgage insurance. This one has an upfront mortgage insurance, which is financed through the loan. And we also have a monthly mortgage insurance. Because of the lower down payment requirement, they do need to have that extra protection layer for in case of a default. So they always have they also do have great interest rates on FHA. Like I was mentioning earlier, I've been seeing rates as low as 5.875. So the potential of lowering your rate with an FHA is definitely a possibility. So it's really aimed at all those people who might not have tons of money saved, for their down payment. This one's a perfect option.
Awesome. Yeah, the FHA is good. And there are lots of, I know when I bought my first place, it was while I was in education. So I wasn't making all the big bucks. And so I was needing some assistance and I was able to take advantage of a first time home buyer program that paid my down payment and it was a silent loan. So it was forgiven after 3 years of
Oh,
me being in the home, and it was great. It was perfect for me, and I've talked about it on these webinars before, but it was part of an FHA program, and it was like exactly what I needed. So FHA is a really, really good program, especially for first-time homebuyers, but it doesn't have to be for first-time homebuyers, right?
yeah, that's true. And then also to add, just how you mentioned, sometimes it is a forgivable loan, or it can actually be a grant. In our case, it's actually a grant, so it doesn't need to be repaid at all. The only thing, of course, is that the interest rate is a little bit higher compared to, what an actual FHA loan is at the moment. But after 7 payments, you're actually able to refinance out of that specific loan into a traditional FHA loan. So that there is that little extra, incentive of doing this program, and then you having that flexibility of being able to refinance also if rates decide
Nice.
to drop. Mhm.
Oh, I love that.
Yeah.
All right. Now let's talk about conventional. Tell us about that. What are some of the pros and cons with conventional?
Yeah, so conventional is more aimed at anybody who already has like a 5% down payment. Does require a little bit of a higher down payment. It also does give people an incentive when your credit score is over 700, just because the mortgage insurance tends to be a lot cheaper than on FHA. Unlike FHA, conventional does not have an upfront mortgage insurance. It's actually not necessary for this program. It's just a monthly mortgage insurance. So I've seen them as low as $100. So in comparison with FHA, sometimes it could be between 200 to 250, 300,
Mhm.
depending on the credit score. But conventional does give that little bit of of a, of a lower payment because of the mortgage insurance. However, the interest rate is a little bit higher on conventional, but I mean, it kind of compensates with the fact that there's no mortgage insurance. And once you do have 20% equity on your home, the mortgage insurance drops out automatically, like unlike FHA, where you actually have to wait until you refinance out of that loan.
Yeah, so pros and cons of all of these for sure. And what I'm hearing is really it's all case by case, and they need to go and talk to you. That's one of the things that I think that a lot of people have a misconception about is they really think that when they are ready to go and buy, or when they're thinking about buying, they don't want to talk to a lender until they're ready to pull the trigger. But a lender is there, just like a real estate agent. We're there to be an advisor, right? We're there to really help you and guide you, because there are a lot of things that you can tell people, like, okay, maybe pay off this debt before you do this, or don't pay off that debt, or wait on this, or whatever. And people don't realize that a lot of times. I know I've heard people every so often say, like, oh, they're just going to try and sell me. And I'm like, why is that the thought? I don't know why that's the thought. It's like, we're here, both of us are here trying to be an advisor. And like, there's so many different options. And it just, to me, is like so clear that it's case by case, and we have to go in and say, okay, what's going to be the best deal for my exact situation?
Correct. Yeah, and that's a good point too, because I've heard a lot of people that say like, "Oh, I'm not ready because I have a lot of debt." But sometimes, we as lenders actually don't go based on the full balance of the credit card or loan, personal loan that you may have. We actually go based on minimum monthly payments. So if you have, let's just say for an example, if you have a $5,000 personal loan, but your payment's only $25, you may think that you don't qualify because you have $5,000 of debt under your name, but the reality is that we go based on the $25 payment. So that's when it comes down to, you should, like you said, reach out to us so that we can really dive into your financials, look at your credit. What does it look like? Is there any improvement? Can we maybe tell you to pay certain accounts down so your credit could go up? Or, just give you some tips of advice so that you can get the best mortgage for your specific needs when the time comes.
Yeah, absolutely. Okay, and this next one, the 2-1 buy down. This is not a loan program per se, but this is an interesting way that a lot of buyers have been able to get a really good situation from sellers. And it's a really good way you want to make sure your agent knows about this and your lenders know about this. So tell us what this is so that our listeners know kind of when it would be applicable.
Sure. So, for example, in October, rates were at around 8%. When that time came, a lot of people were, of course, concerned about their interest rate because the payment was going up a little bit. So we noticed that the only way to be able to phase that was to be able to get seller credits. So we can either do, buy down for your interest rate. In this case, this would be option A, or option B was to get maybe seller credit to cover your closing costs. But in this 2-1 buy down, what it really is instead of having, let's just say, an 8% rate the first year when you when your loan was funded, your interest rate was actually 2 points less. So instead of it being 8%, it went down to a 6% the first year. And then it goes up 1% the following year. So it goes up from a 6 to a 7%. So what that means is that your payment reflects that interest rate. And it's not a variable loan. What a lot of people are saying is like, oh, it's going to be a variable loan. My payment's going to be really high in the future. No, that's actually not the case. This is a seller concession, and this money gets sent directly to escrow, and escrow has an account for that amount. So that amount gets put into your payments to be able to reduce that interest rate for the first 2 years. So like I said, it could go down as little as 6% the first year, and then it would go up 1% more the second year. And the third year, it would go up to that 8% that you were initially locked in at. So it was definitely, a great time for buyers to be able to feel less of a like they weren't as stressed out of their because of their payment because of that 8% rate. It was actually a lot lower the first 2 years. And now those people that, unfortunately secured an 8% interest rate, now they're able to refinance. Like I said, now that we're seeing rates in the fives, and they could, then that the good thing too, sorry, a lot of things that I've seen is, like, for example, that money that gets applied into that escrow account, if it was not used, it actually got applied to their principal. So it's not like the money was lost. It's not like the money was forgotten about. It's literally just applied to their principal, and now they're able to refinance. So definitely a great program, and it's still going now. I've been seeing a lot of people take advantage of it still, for that reason, that it really helps their payment.
So you're saying, when would it not be used?
So for example, if they were to refinance earlier, so we have one buy down, right? So 2 years where your interest rate would be lower in case you were to refinance within that time period. Let's say on year one, technically you didn't really utilize year two to buy down the rate. So any amount that's left over for the buy down would get applied to the principal.
Got it. Got it. Got it. I didn't realize that. That's really cool.
Mm-hmm.
So see, there are lots of different options that we can do for buyers. There are lots of ways we can get buyers in there, which is why buyers are starting to come back into the market right now.
Yeah, exactly.
All right, so let's jump in and talk about our predictions. Um, so what we're seeing, what we did see in, over the holidays and stuff like that, is that buyers have been, we've seen some buyer activity slowing down a little bit. And then what we've seen too is that buyers have gotten under contract and then pulled out for one reason or another. And then those homes have come back on the market. Top 3 reasons buyers pause decision. So the number one reason was for mortgage rates. And so one of those things could be like, if they were, and I've worked with a lot of buyers who were saying this, at one point they could afford a certain amount, and then interest rates went up so high that all of a sudden they couldn't afford that anymore.
Mm-hmm.
The number 2 reason was inventory. Well, inventory has been so low for the last 4 years. Since 2020, it's been so low. We have never seen such low inventory consistently in the history of home selling. And so it's still continued to be depressed, especially because sellers don't want to sell and give up their 2%, 3% interest rates to trade up for an 8% interest rate. Well,
Mm-hmm.
now that home price or the interest rates are starting to come down even a little bit, sellers are a little more motivated, and we're starting to see a little bit more inventory come back on the market. And then the third one is affordability or home prices. So that affordability is, remember, real estate prices is always and forever all about supply and demand. If there's a large supply, like there's a lot of inventory, and a low demand, prices are going to be low. If there's a low supply, like low inventory, and high demand, lots of buyers, prices are going to be high. That's what we've seen the last 4 or 5 years. And we're going to continue seeing that because we still don't have a lot of inventory coming to the market.
Mm-hmm.
So I want to talk about a couple misconceptions, and then I'm going to give my predictions, and then Anna, I'm going to have you give your predictions.
Yes, let's do it.
All right. So 3 common misconceptions, and we've talked about some of this, like 20% down. You don't need 20% down to buy a home. Some loans only require 3% down. Of course, those are like, that should be 3.5% down. 3% would be like really special type of loans, but really 3.5%, 5% down, 20% down is not realistic. I mean, it is realistic, but it's not what you have to have. And a lot of people think that they have to save up $150,000, $200,000 to be able to buy a house in this area. And that's just not the reality. They don't have to do that. Another misconception is waiting until prices drop. But waiting will likely have you paying higher prices because inventory is historically low. So this is a little bit of a spoiler. But right now, And just like we've seen the last couple of years, at every point, the housing prices are the lowest that they were because they keep going up. I remember in 2020 talking to some clients of mine, and I remember them just being like, "Oh, are we doing the right thing? Should we be buying right now?" And I was telling them, it is a really good time for you to be buying. This is a really good time for you to be buying. But I said, but nobody has a crystal ball. We don't know what's going to happen. But, like, I just think that this is going to be a really good time. We're going to see it. Interest rates are low. You're going to be in a good spot. Of course, that was in 2020. And we all know what happened. Their house went up by like 50% in, like their appreciation. And so we're going to see housing prices continue to go up because inventory is still historically low and continues to be historically low. So the reality is that even if we had tons of tons of sellers come to the market and sell their houses, inventory would still be low because the problem we're having is that we don't have new builds going up fast enough. And so most of those people who are going to be selling their houses also need to buy. Now, a lot of those people are moving out of state, sure, but not as many as you would think. You hear the numbers and it's like, oh, 300,000 people moved out of California. But it's like, yeah, 300,000 people. There are like
millions.
Millions and millions and millions. Yeah. And so it's all relative. And so we have to remember that inventory is still really low and it's going to continue being low because the housing shortage that we have is on new home builds. So we're going to continue having this issue. So housing prices, they are just going to continue going up. Now, you may see what we saw in like October, November, December, where we saw some housing prices, like houses were listed and then they had to decrease their prices. But that doesn't mean that the housing depreciated. It didn't devalue. It just meant that at that time, that house was not selling for that price. So instead of being worth, $1 million, it was worth $975. That is not a housing crash. That is not what we're looking for. What we're saying is the housing prices are not going to drop to a level where you're going to feel comfortable because it's not set. The stage is not set for that. And what we are continuing to see is that now that we're in the new year, we're headed into the spring market, housing prices are starting to go up again. And we're seeing a lot more buyers come to the market. And so we're seeing a lot of multiple offers again. I just was in a multiple offer situation with one of my agents with 10 other offers. We're seeing it. I mean, and I had another one where I think it was listed for like 2 days and they went under contract and they had like 10 offers that they were given. So we're back. We are already back to that. I don't think we're back to as crazy as it was before where people were giving their unborn children, but we are headed in that direction. All right. Number 3, the other misconception is waiting until interest rates drop. If and when interest rates drop, buyers will flood the market, making the prices go higher. So again, this is a little bit of a spoiler. So all right, let me get to my predictions, and then I want to hear from you. So we already know the interest rates are going to be dropping. It's a matter of when and how far. So the Fed has already said that interest rates are going to be dropping, probably toward probably mid to end of this year. And so that will mean that mortgage rates drop. But when mortgage rates drop, as we talked about earlier today, when mortgage rates drop, that just brings more buyers, which makes housing prices skyrocket. And what happened in 2020, 2021 was that when those housing prices skyrocketed, even though the interest rates were lower and it feels like, oh, I can afford that payment. Well, you can afford a payment for 800,000, but now instead of being able to offer 800,000 for an $800,000 house, you have to offer 900 or 950 or $1 million for that $800,000 house. And now every house in that area is also going to be $1 million. And now you're looking into an area where you don't really want to be, because now that house where it used to be 600,000 is now 800,000. So you're going to be priced out of the area that you want to be if you're trying to wait for interest rates to drop. So the best thing to do if you're thinking of selling this, if you're thinking of buying this year, the best time to buy is now, because now is when interest rates are good. They're better than they were, but they're not as low as they're going to be. And so there are going to be a lot of people who are waiting for interest rates to drop. And when those people come, you want to have already bought your house. You want to already be in your house so that you can refinance down the line. Now, what I think too is going to happen, remember, 2024 is a presidential election year. And so what happens during presidential election years? Everybody wants to make it seem like, oh, everything is great. So they're going to make prices drop. They're going to make interest rates drop before the election. And so everything's going to get crazy before August, September, October. So if you're thinking of buying, you want to do it before the craziness. Don't wait. Don't wait until all of that starts to happen, because housing prices are just going to skyrocket, because it doesn't matter who is sitting president. It doesn't matter who's incoming president, outgoing president. It does not matter. They all are trying to make the economy look better. And so they're all going to try and have housing interest rates go down, housing prices go up. It makes the economy as a whole look better for them. So you always want to think about that in a presidential election year. And if you're thinking of selling, you want to consider that too, because if you're also trying to buy, it's going to be really hard to sell your house and buy, because you're going to be up against all of that competition. So it's going to be better to buy now, to sell now, so that you can buy your next house now. But if you're a seller, you really have the luxury of being able to wait. But if you're also trying to buy, I would say don't wait. If you're trying to buy and sell, you want to do that sooner rather than later, because you don't want to get into the mix of all of the craziness with all of the buyers who are coming to the market. All right, that's my prediction. Anna, let me hear from you.
Yeah, so those are pretty much all the same topics I had. So in regards to interest rates, again, they are going to continue to drop. We heard this from the Fed last year. We heard that they are going to drop. We heard 6 rate drops. So more likely than not, we're going to see low 5s, potentially 4s. We don't know. But in case it does happen, like you said, what happens when interest rates drop? More people come into the market. So although you are getting a quote unquote better rate, you are having to pay more for your home, because now you're competing with more offers. So once again, touching back on what you just said, we definitely want to make sure, if you are looking to buy, the sooner rather do it better than, later, because what's going to happen again is we're going to have a lot more buyers in the market. And, a lot of people look at you and I as, salespeople. So they're always thinking like, oh, they're just trying to sell me on doing it now because of their own benefit. But to be honest, and we are being honest, and we like to be transparent really with all our buyers, this is something we've been seeing in the past. We really want to make sure that if you are truly interested, that you really take advantage of the market now, because we know what's happened when rates drop. We've known what's happened because of the pandemic. There wasn't homes being built either. So that's creating, definitely, like you said, Brittany, a shortage in inventory. So we definitely don't want to be overpaying for homes. We want to take advantage and be able to buy a home cheaper. We don't want to be overspending 100, 200,000, like you said, Brittany. We really want to make sure we can buy a house that's going to be, you know, our long-term investment, and that it's going to be beneficial for us and for our family and for future generations. So yeah, to that's one of my predictions, rates dropping again, like I said, more buyers coming into the market. And also too, with all these programs that are coming out for down payment assistance for first-time home buyers, you know, the state of California got really creative with these because they were noticing that not a lot of people were able to afford their home. So now they're, you know, incentivizing first-time buyers, first generation, to come in with a big down payment to help offset those higher prices. So, and this is something I've been seeing, you know, a lot of people are like, well, how come prices are going up? Well, it's a simple answer. A lot of people's incomes are also going up every year. Every year you get at least a $1, $2 increase on your pay. So what does that mean? That means that prices are going to go up for everything. We've seen it with homes. We've seen it with gas prices. We've seen it with like any food, even like everything that you could think of has gone up since, you know, the past 5, 10 years. Like it's tremendously going up. So we're only going to continue seeing that. So what does that mean? That means that if you can invest in a home early on, do it. You don't want to wait until, you know, now you have to pay 5%, like I was mentioning earlier. Every year, 5%, homes increase by 5%. So the purchase price is going to continue to go up. So it's definitely a good idea for, you know, buyers to look now into buying home, get everything prepared. Even if they're not able to buy, at least they know what they need to do to be able to do so. So yeah, those are my 3 predictions to for this year. And I'm definitely excited for the opportunity to work with anybody because, like we said, you know, we're trying to give people advice. We're not really trying to sell them on doing something if it's not within their means. Like we definitely want to be there for all our buyers who are looking into the possibility of buying.
Yeah, I mean, it doesn't benefit us to make it so that somebody can't, you know, like stay in their home.
Yeah.
So I think that, you know, even for me, you know, when we talk about this is truly, I believe this, I bought in July when interest rates were high because I didn't like, I don't even know what my interest rate is because I don't care because I know that interest rates eventually will fall. And I didn't want to be with like everybody else who was going to be like driving the housing prices up. So I really truly do believe this, like you're saying. So I love that you brought that back to it. Okay, let's talk about the bottom line. All right, wrapping it up. So the bottom line is buy right. Buy when the time is right for you. Don't worry about the interest rates. It's not about the interest rates. It's about buying when it's right for you. If now is not the time for you, then let's wait. Sometimes renting is what's right for you for a season, and that's okay. And then we need to figure out how do we get you into to buying a home because we want to get you there. But don't try and time the market. Oh, which is the next one. Don't try to time the market. Interest rates will go up and down. Buy when it's right for you. And then number 3, reach out to Anaí. Don't know what you can afford? Reach out to Anaí and she will help you figure out the next steps. All right, so the next step is your move. This is all of our information. So if you guys are interested in working with either one of us, we would love to work with you. We'd love to help you in any way that we can. I know for me, like I really love truly helping people just realize their family goals and dreams and make it so that they have a better future for their family. And so that's one of the things that I love to do. So, Annie, do you have closing remarks, things that just final thoughts?
Yeah, like Brittany said, reach out to us with any questions you guys have. Like we mentioned, there are a ton of different loan programs available for first-time buyers or repeat buyers that we can definitely discuss with you. It goes case by case, so we definitely would like to sit one-on-one if possible with, you know, anybody that's interested, just because there are different programs and different options. So reach out to us. Any questions, we're happy to help. That's our info on the screen. So we look forward to hearing from you all and you know, make your homeownership dreams a reality.
That's right. And also after this, you'll get an email with just a link to be able to schedule a one-on-one. And we can do that either with myself or with Anais. So just make sure to let us know what you're looking for, because we want to help you. Every situation is different. Every situation is unique. And so we recognize that, understand that, and can appreciate that. So we want to make sure that we can help you in whatever way we can. All right.
Love that.
So that was it. And we will see you guys next time. Bye.
Bye.